morning, traders. I'm going to go ahead and record a separate discussion about what happened yesterday with Bernanke as far as the dollar and the euro. But this morning, I want to make sure we get a quick recap of the current open positions, revisit them all, see how they're faring in light of what's happening in the markets right now. And as we mentioned that, take a quick look. Bernanke basically sent the dollar sharply lower, and even though crude's down, I wouldn't necessarily, we'll take a look at the chart in crude for a moment, but I wouldn't necessarily credit that to Bernanke. There's been a lot of volatility in crude. The run-up's been largely geopolitical. Even though Egypt isn't a player in terms of crude, it is a player in terms of gas, but really it's more of a contagion fear that rallied crude in terms of the Egyptian unrest. All right, so Dow futures are up triple digits. Nikkei was strong even post-Bernanke, and they remain pretty strong even now. S&P futures, again, strong. So what about what's going on with the dollar and how that's going to affect our positions? You'll notice that darn near everything is gaining against the dollar right now. For those of you that are curious, there is no limit move for the dollar. There is no limit. So yesterday when the dollar was pretty much frozen, I'm actually still trying to figure out what that was, because as far as I know, on the ICE there is no limit. There's no circuit breaker. So I'm very curious as to why the dollar froze, at least on my feed yesterday. And ultimately what I did do is that I transitioned in that post-Bernanke press Q&A session, I transitioned to the euro, and we just watched that euro skyrocket towards 32, the 132 handle, and I knew that meant US dollar weakness. Now, I want everyone to remember that if they have US dollar exposure, for example, with the Aussie US, I like the overall story of Aussie weakness. I don't trust that the US dollar will continue to weaken. I think that the near-term shorts in the dollar had to cover, because Bernanke, and I still think it's absolutely amazing that some people were considering a July taper. I don't think there's any evidence of that, especially if 85 is still resistance on the dollar index. But I think now we have to push out expectations even further than September. At least that's what this sell-off seems to be reflecting. But I do not think this is going to be a pronounced sell-off for the US dollar. Therefore, I still see lower lows for the Euro US. I had a quick discussion about maybe fading the 3,000 level, and obviously that got blown out of the water. I talked about keeping a sizzle for a 3,000 to 30.50 entry at 30.65 and then just getting out of it, because it really was a 3,000 fade setup, even though there was an argument for that having been maybe the first of the potential swing trades that we're going to see. I still see lower lows for this, and I have actually put a discussion about the Euro US dollar, about the Goldman Sachs FX desk, and as well as the Credit Suisse take on momentum through the 3,000 level. And I don't see that happening. I just think that for now, the euro got a reprieve because the dollar had to, a lot of those longs had to go ahead and get flat, or at least maybe even reverse position, in terms of dealing with a taper that may not come till perhaps next year. So now we have to recalibrate what our tapering expectations are. Moving on to where we are with the current book, and realize that that dollar discussion is going to affect the Kiwi US dollar position. I still like Kiwi strength in terms of its relationship against the other COM dolls, but I don't like Kiwi strength against the US dollar. And we have an overall downtrend. Yes, it took a heck of a scenic route, but remember, if this were actually a rally on the Kiwi, I'd be concerned. This is actually a dollar weakness play that rallied the New Zealand dollar US dollar pair. So know your driver. Same thing applies to the dollar Canada. So when you take a look at the US dollar Canadian dollar and you see the pullback, and yes, this was a scary, scary pullback. I was watching it like I know a lot of you were as well. And the reason this pullback for me remains kind of a temporary situation is because ultimately I don't think let me ask you this. Either we do one of two things in a lot of these dollar correlated pairs that we're in. We're either going to get flat, or we're going to basically hang on and or recalibrate. So some of you might have taken a small hit or taken a large hit and want to get back in, or I'm guessing most of you did like I did, which is you noticed three things. Yesterday's Bernanke event was like a perfect storm for the dollar index because it happened at just the most ridiculous time. It was an anticipated event. The minutes revealed nothing, and the Q&A was dovish. The market was close, and then we rolled into the most comparatively illiquid time in the Forex market. We were rolling into Asia. In fact, we were in the gap. We were in the most... Are there doldrums in the Forex day? Absolutely. Now, the biggest doldrum is between the U.S. close and the Asian open, which creates about a 2.5, 3 hour space between the 4 p.m. Eastern Wall Street close and around 7 p.m. when the Asian session really gets humming, really arguably closer to 8 p.m. Eastern. So we have 2 hour doldrums between lunchtime and certainly after the European close at 11:30 a.m. Eastern. But we were in the worst part of the daily doldrums, that cycle of what we see every day. We were in the worst part of those doldrums, and that's when we get this impactful news where basically Bernanke comes out with these extremely dovish comments. So, and by the way, when I talk about dovish comments, what did he say? What was the sentence that basically was heard around the world? He said highly accommodative, not just accommodative, highly accommodative monetary policy for the foreseeable future is what's needed in the U.S. economy. Now that in and of itself doesn't mean anything. He just said, I'm going to be highly accommodative. But what traders did is they read between the lines. Accommodation accompanies a presumption that the economy isn't ready yet to have us, it's like a patient. The patient's still on some sort of life support. And Bernanke's not willing to take them off it yet because they're simply not healthy enough. That's what the market took that as. But then I know some of you are wondering, well then how come the Dow is rallying? Raghee, if things are so bad, how come the Dow is rallying? Well, this is the ridiculous nature of one, the equities markets, where now they know they're back on the crack. The 85 billion per month is going to continue. So why not buy the Dow? And in fairness to equities bulls, there really is nowhere else to put money because you're not going to yield any other return, decent return anywhere else. By the way, that's why the FinMin comments from New Zealand were so strange for the New Zealand Finance Minister, Bill English, to come out and say that the rates can't stay low forever and that New Zealanders should not get used to it. That was just an unbelievably ridiculous comment to make because money is seeking yield like nobody's business. And when Bill England comes out and says New Zealanders think that they're going to have 5% rates forever, well, they aren't. They are going to go up. It's just a matter of when. That just gets people thinking, well, maybe I'll start buying some Kiwi and get some yield out of that thing. So lots of interesting and strange comments coming out of these political figures. Politically and economic, really relevant figures. All right, so where does that put something like the Kiwi US dollar? Again, I still believe that it's a solid short, but in the meanwhile, it's going to take a scenic route. Do I think the Kiwi is the strongest of the ComDolls? I absolutely do. So continuing to short things like the Aussie US makes a whole lot of sense to me. Aussie US. I know some of you told me that you took that Aussie Swissy short that I sent out yesterday morning. And that has been a terrific short. Yes, it had some fluctuation because of the Swissy's relationship back to the euro, but that was a terrific short. So I know some of you are wondering what to do with that now. Remember that this is still based on Aussie weakness, so I have no problem with you maintaining an open short in the Aussie Swissy. We just don't have anywhere else really to execute it today. And sometimes, yeah, timing matters. Yesterday was the day to take advantage of it. Today's the day for follow through. If you want to take advantage of it intraday, you're really limited to maybe a 5-minute in the near term, or you're hoping for a correction north of 87.50 to execute even just an aggro 60-minute short sell on that Aussie Swissy. So, you're talking about maybe a level like this in the 87.50 area, right around here. I mean, that's really all you've got to be able to short that level. So we're talking about an aggro short around the major psych level, and that's a 60-minute short. By the way, I know this doesn't have the greatest DB, but I think it still maintains enough bearishness, and I still like the bearish Aussie story. I think it could outpace the weakness in the Swissy, and that opens a 60-minute up to being a valid time frame to watch. All right, I know we're jumping all over the place, but all these stories tie in. You know, you really can't just dive into the pairs that thinking about what's happened here in the last, last 12 hours, a little bit more than that, last 15 hours actually. More than that actually, but the way Asia had to handle it is why we saw so much volatility. I'm telling you now, if this was a noon event and not a 5 p.m. event, would we have had the dollar sell-off? I don't think we would have had the latitude for traders to run the kind of stops that they did, minus the illiquidity of the doldrums between the U.S. close and the Asian Open. It would have been a completely different event at a different time. So, yeah, that's a very interesting part of this whole thing, which was if this happened really during a more liquid time, this would have been, I think, a much less pronounced event. This market doesn't go running stops to this level without that being basically an event happening at the most illiquid time of the day. Really just boggles the mind. All right, what else do we have? Well, the pound Aussie and the euro Aussie, I mentioned I'm still not fond of these positions. The pound Aussie, I think, is relatively stronger just by a little bit than the euro Aussie. This pound Aussie is a position that I've had open since the 5th of this month. I'm not going to be looking for higher highs. In fact, the euro weakness story concerned me. It still does. I won't argue that we're still in an uptrend. It still does concern me, but I like the pound Aussie story a little bit better, and I'll be looking to probably take this trade off the table, or at least start to minimize my exposure to it. I'm not going to look for a resumption of the uptrend. We have this high here sitting at about the 50 pip level, so there's some resistance for us right there, around 65.50 on this pair. And then beyond that, I'm pretty certain I'll be flat by the time we get up to maybe the 66.90 area. I don't have a large position anymore, so I don't have the latitude to squeeze it a whole heck of a lot while also peeling off the position. So I think it'll be smart to realize a little bit of a profit at this area here after a fairly significant run up. I want to remember that. Why am I concerned about this particular run up? I mean, we got a lot of momentum here. Why am I concerned about this? Let's jump on over to the power stats, and if you haven't done this, I think it's pretty important that you take a look at it, because what we have here today, let's get the calculator into view. What we have here today is a move from a high, current high of 65.60. So I have a 65.60. I'm going to subtract the low, which is sitting at 62.64. So I'm subtracting 62, 64. I know the math is pretty easy on this one, just shy of 300 pips. Where does 300 pips, 296, put us in terms of the pound Aussie's movement? We were well beyond, I mean, if you take a look at the movement per hour during the event, if you were to go intraday, 5 minute, when we started moving, actually I'll go to the 1 hour chart. When you start looking at the kind of moves we were making, ultimately, cumulatively, we're well beyond the daily, I believe. Let's take a look at that daily. I shouldn't guess. I actually don't know the pound Aussie off the top of my head. Okay, so, okay, it is quite high. All right, so 230 on the extreme. The average, you can see we're way above the average. but the extreme is about 230. So again, you compare that 290, almost 300 to 230. When I talk about this market maybe reaching a level at which it's going to start to exhaust, this is why. Okay? I know we have plenty of reason to think that this market is in play, but it's in play, I think, predominantly because of the US dollar. Okay, so this is what I'm seeing, and this is why I think it's probably a good idea to think that we probably don't have much left in the tank, and it'll make sense to start to, at least, if nothing else, take a little bit off the table and start ratcheting those stops and making sure that, you know, look, when a trade turns into winner, that's your money now. Okay? I think oftentimes, psychologically speaking, we'll probably do more to protect what's ours than to go get it in the first place. Okay? We will be much more vigilant, much more protective, much more sensitive to protecting what is ours than going getting something. Okay? So with that in mind, this money is now yours. Okay? This pippage is now yours. Act like that. Protect it now. So put this at a reasonable hourly distance away, which means you probably are talking about giving this thing wiggle of about 40 to 50 pips. Notice I'm on a little bit high side of the average here, especially during the European-US overlap, but give it about 40 to 50 pips to wiggle, which means in this case I'll probably go ahead and let the pound Aussie wiggle its way down to maybe 64.90 before I really start to get too nervous. But for those who are saying, you know what, 65, 60, you know, either this thing stays above the 20 pip, or even if you're really tight on it, the 50 pip, and I'll go ahead and take my profit at that point, and then I'll squeeze the remainder as long as we stay above the 165 handle. That's definitely a very logical, solid way to do it. Okay? I will tell you that my worst position, my most troubling position that I have is, of course, the lone euro short that I have, and I'm probably looking at having taken this thing probably further than I should have. Yes, I'm probably this thing happened so quickly I wanted to recalibrate, reevaluate, and at this point, how am I managing this euro kiwi? I actually had a long position in this that I took as a rollover. The kiwi slaughtered the euro slaughtered everybody, and the euro kiwi is no exception. So whether it was a euro US, whether it was a euro kiwi, there's just no way to sugarcoat this. Okay, none whatsoever. So what I'm going to do is I'm going to put a slow stochastics on this chart to 21 period, slow stochastics, and what I'll do with this is I'll start to look for where I think we could exhaust. Now, this is not going to be easy because I don't have a logical previous breadcrumb high that I think is just one that means a lot before I get up to 6,800. And that's a pain in the neck. Sorry about the background noise or taking care of the landscaping here outside my office. So the only way I can manage this, and luckily this is a fairly small position. It's a 4 lot. I don't mind trying to add another 2 lots to this, but the problem is where. Okay, that's really the problem. Is it going to be at a high of, say, 67.50? Am I going to push this thing up towards 68.20? I mean, where is the level? That's the problem, and I'm not going to step in front of this freight train right now because take a look at my building blocks. They're still heading up. Should I be in this position? Probably not. Okay, I'm dealing with a very unusual situation with Bernanke basically kicking in the teeth of the dollar index, and hence it's not euro strength, nor is it really kiwi weakness that's driving this thing higher. It's the weakness in the US dollar. So as long as the weakness in the US dollar lasts, that's how long the strength in the euro lasts. So dollar's not doing me a whole lot of favors right now. Again, should I be in this position? Probably not. But again, yesterday was just a very unusual set of circumstances. So let me show you my current book as it stands right now. Again, the problem position I'm dealing with certainly easily is anything that I have that it was based on US dollar strength, and anything that, of course, was based on euro weakness. So admittedly, I'm probably taking this euro a little too far, but I'm going to continue to reevaluate. I still think it's within tradable area, but I don't, when you wonder, did the market see this coming? And I'll leave you with this thought. When anybody says, oh yeah, the dollar was weak before the Bernanke event. Oh yeah, the dollar was definitely, aching for a short. I will admit that anything that was below the 85 level and that was keying off these previous highs definitely suggested exhaustion. No doubt. What really caught traders off guard was the speed and the scope of the move, just the sheer velocity and how far it was willing to go with that velocity, with that speed. Most of the time the market can be like a drag race, right? You guys ever watch NHRA? The market's not necessarily like NASCAR. When these moves happen, it's like a top fuel car. It's going to go the quarter mile in about 3 seconds. So it has that kind of power and speed, but for a very short amount of time. What was so unsettling about yesterday's move was just how long it was able to keep up that top speed. So do I think that's ultimately sustainable? From a price action standpoint, no. Do I think it's fundamentally logical? I still don't think it's fundamentally logical, because all traders really had to do, this was the move yesterday. And this is why I say there was really no way you could say this was the obvious place to be. I don't think necessarily buying the dollar up here was smart, but thinking long dollar overall, longer term, as we have been doing, probably was. It was probably smart to perhaps fade 85 if you were a short-term trader, just like it was smart to fade 128, but that doesn't make it a trend. It just means you found the extreme ranges. So yeah, arguably any of my dollar long positions were in danger of some dollar exhaustion, but the whole point of putting on any of the dollar long positions was to find a tomato can on the other side, a weaker currency, case in point, something like the Aussie US. Okay, we already have a trend, and I suspect that the Aussie will continue to weaken at a quicker clip than the dollar. Anyone who says they knew this was coming, overall, the market absolutely did not. And here's why. Look how much it had to move to discount it. Okay, so don't ever feel like, oh, this move came, I should have known. Nobody knew. I mean, was somebody know? I guess somebody got lucky and faded 128 just like they faded 85. I shouldn't say lucky. They executed a distribution fade plan, and that plan worked. They picked a top or bottom in an overall choppy market, and they were rewarded. But it doesn't make it a trend. Okay? So the market reacted the way it did because this was a surprise. So don't think that surprises, one, won't happen, and two, won't happen to you. I'm sitting in the middle of one right now with exposure mainly to the euro against the Kiwi, but also my dollar long positions are suffering. But luckily I have an overall position that's based on a trend, and I think I'm still pitted against tomato can individual currency stories. All right, that's the morning update. I'll see you in the next video.